Gold at $5,050 is not the story. The real story is the floor no one can break. Gold is down. That's what most traders see. On February 10, 2026, spot gold trades at $5,050 per ounce, down $53 on the day. Silver trades at $82.50, down $1.16. Headlines say profit taking. Commentators point to overbought technicals. Analysts talk about positioning ahead of U.S. jobs data and inflation numbers. It looks like a normal pullback, but it isn't. Because the most important thing happening in this market right now is not the correction. It's the floor. And that floor is not being set by retail traders, not by hedge funds, not by ETF flows, and not by momentum algorithms. It is being set by central banks. And once you understand that, you stop looking at gold corrections the same way ever again. The $5,000 threshold was supposed to be resistance. Think about where we are. Gold is above $5,000 per ounce. 10 years ago, that number sounded absurd. 5 years ago, it was considered extreme. Even at $3,000, mainstream finance was calling it a bubble. Now we are at $5,050. And instead of collapsing after breaking that psychological barrier, the market is absorbing profit-taking and holding structure. That alone should tell you something has changed. But the real shift is underneath the price, because this is not a rally built on speculation. It is a rally built on accumulation, permanent accumulation. The quiet 15-month buying streak. On February 9th, 2026, it was reported that China's central bank added to its gold reserves again in January. That makes 15 consecutive months of buying. 15. Let that sink in. This is not opportunistic dip buying. This is not tactical. This is not reactionary. This is policy. And when a central bank buys gold for 15 straight months, it is not doing so because of short-term price fluctuations. It is doing so because of strategic reserve reallocation. And that changes everything. The difference between speculation and sovereign accumulation. Most people treat all gold demand as equal. It isn't. There are three types of buyers in the gold market: speculators, investment flows, ETFs, funds, momentum players, sovereign accumulators. The first two care about price. The third cares about control. Speculators will buy at $5,000 and sell at $5,200. ETF holders will buy when sentiment is strong and liquidate during volatility. But when a central bank buys gold, it does not resell it back into the market. It removes it permanently. It moves large 400-ounce bars from the tradable float into sovereign vaults, where they become inert, unavailable, non-circulating, strategic. And that is what creates a structural floor. The floor. No one is talking about. When traders look at support levels, they look at moving averages, Fibonacci retracements, previous breakout zones, options positioning. But those are technical floors. This is a structural floor. A structural floor forms when a buyer with unlimited time horizon and no sensitivity to short-term price volatility commits to absorbing supply consistently. That is exactly what central banks are doing. China is not alone. Across BRICS and emerging market economies, gold reserves have been steadily increasing. Central banks are diversifying away from dollar-denominated assets. They are reducing treasury exposure, and they are increasing hard asset reserves. This is not a secret. It is reported data. But what most people fail to grasp is the magnitude of its impact on market structure. When sovereign buyers step in at scale, corrections stop behaving like they used to. They become shallow, they become brief, and they become opportunities. Why this correction is different. Gold is down just over 1%. Silver is down 1.38%. This is being framed as profit-taking ahead of U.S. economic data. Yes, traders are repositioning. Yes, DXY softness is part of the equation. Yes, inflation and jobs numbers matter. But here's the key difference from prior cycles. There is now a known, visible, confirmed sovereign bid underneath the market. That did not exist in the same persistent form in prior decades. In the early 2010s, gold could drop 20 to 30% because ETF outflows overwhelmed the market, and there was no guaranteed buyer of last resort. Today, every meaningful dip is met with physical accumulation. Not paper, physical. And that distinction is critical. Permanent removal of float. Every ounce a central bank buys reduces the available float, and the gold market float is smaller than people realize. Most gold ever mined still exists, but most of it is. In jewelry, in private vaults, in sovereign reserves, in long-term holdings. The portion that actually trades freely is a fraction of total above-ground supply. So when central banks consistently pull large volume bars into reserve storage, they are tightening an already limited float. It doesn't explode the price overnight, but it changes elasticity. And elasticity determines crash potential. Lower elasticity means sharper upside moves and weaker downside momentum. That is exactly what we are seeing. Why $5,000 is not a blow-off. Top retail investors often fear round numbers. $5,000 feels extreme. It feels late. It feels crowded. But crowded markets do not correct 1% after massive moves. They collapse. This is not collapse behavior. This is digestion behavior. There is a difference. Collapse happens when leveraged speculation drives price vertically and then liquidity evaporates. Digestion happens when structural demand absorbs speculative excess. Right now, we are seeing digestion, and that tells you something powerful about who is in control. The central bank floor changes asymmetry investment is about asymmetry, limited downside, expanding upside. Gold today has something it did not have in many previous cycles, an identifiable sovereign bid at elevated levels. That means crash risk is reduced, liquidity events are cushioned, deep retracements are less probable. Does that mean gold cannot fall? No, but it means that every correction now must compete against state-level balance sheets, and state-level balance sheets do not trade on RSI. Silver's relative strength is a warning signal. The gold and silver ratio sits near 61. That is historically low relative to prior crisis periods. Silver is holding strength. Why? Because silver demand is not just monetary, it is industrial. And industrial silver demand is accelerating due to electrification, solar expansion, semiconductor demand, defense manufacturing, battery technologies. So while gold is being accumulated as sovereign collateral, silver is being consumed as industrial necessity. That creates a dual pressure dynamic, monetary floor under gold, industrial floor under silver. When both floors exist simultaneously, the precious metals complex gains structural resilience. The dollar is soft, but that's not the core driver. Yes, the DXY has softened. Yes, currency fluctuations matter. But if you think gold above $5,000 is primarily a dollar story, you are missing the larger shift. This is about trust architecture. Global reserve diversification is accelerating. BRICS payment systems are evolving. Trade settlements are slowly becoming less dollar exclusive. Even modest diversification creates massive capital flow shifts because the dollar system is so large. Central banks do not need to abandon the dollar to change the gold market. They only need to reduce marginal allocation. And that is exactly what they are doing. Gold as balance sheet. Insurance. Gold is not being bought for speculation. It is being bought as balance sheet insurance. Insurance against sanctions risk, currency devaluation, treasury volatility, payment system, fragmentation, geopolitical conflict. When sovereign entities face uncertainty in financial architecture, they accumulate neutral collateral. Gold is neutral. It is not another country's liability. It cannot be frozen digitally. It cannot be printed. It does not depend on counterparty performance. In an era of weaponized finance, neutrality becomes priceless. That is why gold is being accumulated at record levels. Why this matters for private investors. If central banks are absorbing supply at or above $5,000, what does that mean for you? It means corrections are structurally different. When speculative flows sell, sovereign flows absorb. When ETFs reduce exposure, central banks increase reserves. That creates lower crash probability, higher long-term floor, greater convexity to upside events. In plain terms, dips become strategic opportunities rather than existential threats. That is a massive shift in risk profile. The psychology of profit-taking. Let's address today's move directly. Gold down 1%, silver down 1.38%. This is profit-taking ahead of US jobs and inflation data. Traders are reducing exposure. That is normal. But notice what is not happening. We are not seeing panic liquidation. We are not seeing cascading margin calls. We are not seeing disorderly price action. The correction is orderly, measured, contained. That is what a structurally supported market looks like. De-dollarization is not a headline. It's a process. Many dismiss de-dollarization as exaggerated rhetoric. But de-dollarization does not require collapse. It requires marginal shift. If global reserves move even 5% allocation from dollar-denominated assets into gold over time, the impact is enormous. Because reserve pools are massive. Central banks operate in trillions. Gold markets operate in billions. That imbalance is powerful. It means sustained official sector buying can overwhelm private selling pressure. And that is the dynamic forming right now. Silver's spillover stability. As gold stabilizes under sovereign demand, silver benefits indirectly. Industrial users and jewelers gain confidence in price stability. Hedging becomes more predictable. Inventory planning becomes more manageable. When gold volatility compresses due to central bank absorption, it reduces systemic shock risk in the entire metals complex. That supports silver structurally. And because silver's market is much smaller, incremental capital flows create outsized moves. That is why the gold-silver ratio compressing matters. It signals silver is not lagging, it is leading. The crash potential has changed. In prior cycles, gold could fall 30-40% during macro tightening phases. Today, ask yourself, who is selling aggressively at $4,500 if central banks are buying at $5,000? Who is unloading into sovereign demand? Large drawdowns require supply imbalances, but if sovereign entities are absorbing supply at scale, imbalances become harder to sustain. That doesn't eliminate volatility, it limits depth. And limited depth with expanding upside drivers creates asymmetry. What to watch next? If this structural floor thesis is correct, we should see continued central bank reserve additions, shallow corrections rather than deep retracements, persistent strength in physical premiums, tightness in large bar availability, gold holding higher lows over time. If instead central bank buying stops abruptly, that would weaken the floor. But as of now, the data shows continuation. 15 months is not random, it is commitment. The bigger picture, zoom out. Gold above $5,000, silver above $80, central banks buying aggressively, dollar softening at the margins, geopolitical tensions unresolved, industrial demand accelerating. This is not late cycle euphoria. It is early stage repricing of trust. When trust in monetary systems shifts, repricing is nonlinear. It happens slowly, then suddenly. We may be in the slow phase. The new asymmetry gold used to be a hedge against crisis. Now it is becoming structural reserve collateral. That transition changes its behavior. If sovereign buyers continue absorbing supply, gold becomes less cyclical and more strategic. And when an asset becomes strategic, price targets from prior cycles become irrelevant. The question stops being, is $5,000 expensive? And becomes, what is the correct reserve value in a fragmented financial system? That is a very different question. Final perspective. Today's correction is noise. The floor is signal. Gold at $5 to $50 is not the story. Silver at $82.50 is not the story. The gold-silver ratio at 61 is not the story. The story is this. For 15 straight months, one of the largest central banks on earth has been permanently removing physical gold from circulation. That creates a structural bid. That bid reduces crash probability. That reduction increases asymmetry. And asymmetry is where long-term opportunity lives. This market is not behaving like a bubble. It is behaving like an asset being reclassified at the sovereign level. Corrections will come, volatility will remain, economic data will matter, but underneath all of it sits a floor that did not exist in previous decades. And floors, once established by entities with trillion-dollar balance sheets, are not easy to break. Watch the reserves, watch the corrections, watch the physical flows. Because if this structural shift continues, the real story is not that gold reached $5,000. The real story is that $5,000 may eventually look cheap in hindsight.